Tired of the USA and want to track worldwide growth in one click? Let me show you how. In recent weeks, we've seen the US stock market be very volatile and show signs of decline. We've seen a correction, which is pretty much hitting 10% within the S&P, and the Nasdaq has gone past that, I think dropping 12% since its peak. And people are now starting to doubt the long-term prospects of the US stock market, which is a change in mentality, given how strong and how backed the US stock market has been, at least especially over the last couple of years, with the amazing year that we had last year in the S&P 500. Alongside this, we're seeing people always want to become more diversified as investors. That's always a key word. So being able to track worldwide growth is something very appealing to investors, and that is something that you can do through Trading 212 and other platforms with one click. But what I want to run through today is why it might not be as good as it sounds. So I've got Trading 212 up, and what I'm going to do is go to the search feature, which is in the top right. Couldn't find it then. And what you want to do is type all world. And what you will see is Vanguard's VWRL is, I think, the gold standard really for an all world tracking fund. And FWRG is Invesco's more recent edition. And what these are, as all world, as that denotes, is these are ETFs that in theory track worldwide global growth. So what in theory you'd think that you're doing is reducing any reliance on one single country, and you can track global growth, which I think is appealing, with some countries looking good and bad. See, China's always hard to read, places like Hong Kong, developing markets, emerging markets, you might think you want a bit of exposure to there, but make sure that you do keep exposure or a lot of reliance on Great Britain, on the US and other key long-term players that have history of good growth. If I click into VWRL on Trading 212, and this is sort of one of the issues with Trading 212, is that they don't have good breakdowns for all ETFs. iShares, for example, it often shows sector splits, geography splits, and gives you a bit of data. This, for example, gives you next to nothing other than being able to see price history. And if we do look at that price history, what we see is pretty good consistent growth. So this is going back as far back as 2019. We had the dip from COVID, and then it's been pretty much consistent up until this last week or two, or last month, where it's dropped 7%. And what you may notice with this is that this history, this trend does look somewhat similar to the way the S&P has performed over this period, and I'm going to get more into that in a second. So I'm on the Vanguard website because this will give me a lot more information on VWRL, and this comes in accumulation or distributing. I don't really want to get into exactly which all world fund to pick if you want to pick one. But what they share, Invesco, which I've got on another website here, and the FTSE, is they both track the FTSE All World Index, which is a separate index. And if I go down the Vanguard website, you see here that the VWRL has 3,655 stocks. So it is highly diversified on stock number perspective, and that number greatly exceeds what is normal for an ETF, and is probably one of the highest numbers of separate holdings that you can actually invest in via a single ETF. And that is the joy of ETFs, that you don't have to go through the hassle of buying 3,600 stocks individually, that you can just do it through one click. We see other things here like PE ratios, book ratios, return on equity. I don't want to go through that. That may be a separate video. But this is what we wanted to get to, which is region exposure. So this is from the 31st of January, and this will have changed, I think, given how poorly the North American markets have performed over the last month since the 31st of January. But we see 67% exposure to North America, 14% to Europe, 9.4% to emerging markets, 9% to Pacific, and 0.2% to the Middle East. Now, obviously, this what this does show is that it does track the entire world to some extent, but the exposures are far from even, which has some benefits. I think, for example, if the Pacific, if it was equally weighted across all of them, the overall performance historically wouldn't have been as good. Because, for example, Pacific or emerging markets haven't performed as well as North American markets, though if diversification is your aim, this isn't really delivering it as well as you would think. But this is expected, really, though. The North American market is dominant. The European markets as well, quite big. But this isn't too far off, really, from just buying an S&P 500, S&P 500 tracker or an ETF. It's that with some minor exposures elsewhere. If we keep going down, we can see, again, 65% US, the Japan, the Nikkei index, 5.6 UK, so you're thinking FTSE 100, FTSE 250, 3.5%, 3% for China, which is very small given the size of that market, Canada, France, Germany, the DAX index there, India, Taiwan, which is key for semiconductors and some tech items, and it keeps dropping. So there is a decent number of specific countries, but the weightings are far from even. It's also key to look at the exposures by sector. This is less of an issue for the All World Index because the All World is a regional. It's not called an All Sector Index. But looking at this though, we see 28% for tech, which I think we would expect. 15% financials, 15% consumer discretionary, industrials, and that continues to drop. And we do have the key holdings here. So this is an all-world index, though the Mag 7, the top 7 stocks, do sort of reign supreme here. 4% Apple, nearly 4% Microsoft, 3.5% Nvidia, Amazon, Meta, Alphabet, which is Google, Broadcom. This is not as diversified as you would think, and many of the holdings will be 0.0100, multiple decimal places or lower than that. Again, if we look at the Invesco page, which I think I prefer, the Invesco page is a little bit cleaner. Again, sector exposure, pretty much the same thing. And country exposure, again, very, very similar. It's US dominant funds here. So what I've done here, just to illustrate some of this point, is I'm looking at an S&P 500 sector weighting, and what we see here is 30% tech, 15% financials, and 10% healthcare, 10% consumer discretionary. And if we go back to the Invesco, what we see is pretty much identical or very, very similar sector weightings. So what we can see is dominance really by the S&P 500 within this ETF. Financials, for example, is higher in the all world because it has exposure to things like markets or indexes like the FTSE and the DAX, which are quite financially heavy or a lot heavier than the S&P 500 is, and they are also a lot more industrial led, which in the US will be the Dow Jones and other indexes, but generally the European markets are more industrial than the US. So I'm not saying that the all world is pointless or that it's not something you should invest in. Obviously, this is not investment advice to go and do your own research, but it is blind and not necessarily an optimal thing just to go and invest in the all world without looking at the prospectuses and some of the investment documents, which is why that's always important in terms of doing your own research. If you want true diversification across geographies, the FTSE All World will not necessarily cut it, and this is where items or platforms such as Trading 212 with its pies feature allow you to tailor weightings of different indexes, for example, and basically do create or recreate a FTSE All World with a more fair weighting or with weightings that you may prefer. For example, my pie that I'm investing in currently that I've created, I am aiming for about 40% exposure within the US markets and more increased in Europe, which is a slight bit of a difference to the way the FTSE All World is weighted. But what that is, that's just my personal preference at the moment with the way the markets are, and that's something that each person can decide for themselves. But the key thing is not to just blindly buy the FTSE All World thinking that you are perfectly tracking the global growth, because it is too highly US domiciled to do that effectively. Well, thank you guys for watching. Please put any comments, any feedback, anything in the description box below. Obviously, please subscribe and like it if you've made it this far into the video. All support is really appreciated. But anyway, it's been Harry from HTL Finance. I'll see you next time.